If you work in tech, the thing that decides whether your disability policy actually protects you is how the carrier counts your income. That's true for software engineers, data scientists, cloud engineers, product managers and designers, and pretty much every other role across the sector. Tech compensation runs base salary plus bonus plus equity, and those three pieces get treated very differently in underwriting. Miss that, and you end up paying for a policy sized to a fraction of what you really earn. Over the next few minutes, I'll cover how carriers count RSUs and bonuses, what occupation class tech professionals get, and why it changes your price, whether your employer's group coverage is enough, and how mental health coverage works for tech and what shifts if you're on the finance side. I'm Jack. With Seaworthy Insurance, we specialize in disability insurance for software engineers and other high-income tech professionals. Let's start with income. Start with the simple parts. Base salary counts directly. Bonus and commission, they count too, and carriers generally average them over about 2 years. So one enormous year or 1 weak year doesn't distort the number. For a lot of engineers, that's already most of the picture. Equity is where people get surprised. Carrier income guidelines defined earned income as salary, wages, commission, and bonus. And none of the 5 major carriers name RSUs or equity as its own insurable category. What happens in practice is more useful than that sounds. When your RSUs vest, they land on your W-2 as wages, and income reported that way generally counts when it's documented and recurring. A steady vesting schedule that's been showing up on your tax returns for a couple of years is usually workable. A single large cliff vest gets weighed more carefully because the carrier's trying to size a benefit against income you can actually count on year after year. What doesn't count matters just as much. Unvested RSUs don't count, unexercised options don't count, the discount on your employee stock purchase plan does not count. And investment income, dividends and capital gains is unearned income, so it sits outside this entirely. If you're holding a large unvested grant, that isn't something you can buy coverage against today. So the practical move is to bring about 2 years of tax returns, along with your vesting and bonus records. That documentation is what turns your actual compensation into benefits. Occupation class is the carrier's risk tier for your job, and it mostly drives your premium and which riders are available to you. Tech does really well here. Software engineers, developers, product managers, and data scientists are generally classed 6A, a top office class on the general white-collar scale, low-hazard cognitive work. 2 specifics worth knowing. MassMutual runs its own class scale, and a software engineer with a computer science degree or 5 or more years in the career can be written at 5A5. That's the highest occupation class MassMutual assigns. Different scale, same result. You're at the top of it. Class also varies by state. Principal doesn't offer 6A in California, and its top office classes in California and New York run 5A Select instead. Your class isn't uniform nationwide, and that's part of why the same engineer gets meaningfully different offers from different carriers. Almost every tech company offers group long-term disability, and it's better than having nothing at all. It's also built on your base salary, which brings us back to the problem we opened with. Group long-term disability typically covers base only, so the bonus and equity making up a large share of your compensation never enter the calculation. It caps the monthly benefit, often well under what a senior person in tech earns. When your employer pays the premium, the benefit's generally taxable, so the figure in the benefits portal isn't the figure you'd actually bank. And it stays behind when you leave, which matters in an industry where people change companies every few years. An individual policy is owned by you, priced on you, sized against your total earned income rather than base alone, and it follows you from job to job. On taxes, premiums, you pay yourself with after-tax dollars, generally produce tax-free benefits. Tax situations do vary, so confirm yours with a tax professional. Tech gets treated better than medicine on this one. Carriers group certain occupations as higher risk for mental health claims. Anesthesiology, emergency medicine, pain management, CRNAs, general dentistry, those occupations are typically pushed into a 24-month limit on mental health claims. Benefits stop after 2 years even if you still can't work. Tech isn't on that list. Full benefit period mental health coverage is available across all 5 major carriers for tech occupations, though the route there differs by carrier. With some, it's the default. With others, the 24-month cap is an optional discount. You can decline, and with one, it comes through an endorsement you add. The caveat is your state. California is the weak spot, where several of those options either aren't sold or the cap is required regardless of class. If you're in California, ask about this specifically instead of assuming it's included. On the finance side, the compensation problem has the same shape with different labels. Base plus bonus, base plus commission, or carry. The bonus and commission piece counts and gets averaged the same way, and the documentation is the same, roughly 2 years of returns, plus the records behind your variable comp. Occupation class tends to work in your favor too. MassMutual banded a group of high-income finance roles up to 5A5, including CFAs, hedge fund and venture roles, and stockbrokers at incomes of $250,000 and above. So a well-paid finance professional lands in a favorable class. The group coverage gaps carry over as well because group LTD is built on base salary in finance the same way it is in tech. And in a comp structure where bonus is most of the number, that's a wide gap. Recap. For tech and finance professionals, the question is how much of your real income the policy actually covers. Base, bonus, and commission count, with bonus and commission averaged over roughly 2 years. Vested RSUs generally count as W-2 wages when documented and recurring, while unvested grants, unexercised options, and the ESPP discount don't. Tech classes, well, generally 6A, and MassMutual will write to software engineer with a computer science degree or 5 years of experience at 5A5. Group coverage is built on base, capped, taxable when your employer pays for it, and it doesn't leave with you. Full benefit period mental health coverage is available to tech across the 5 major carriers, with California as the exception worth asking about. If you want to see what your total compensation actually supports in coverage, that's what we do at Seaworthy Insurance. We're a disability insurance specialist for software engineers and high-income tech professionals. The full written guide is linked in the description. Thanks for watching.